All right, guys, let's get started. Hello, everyone. Welcome to Make Money While You Sleep channel and the community. My name is Varun, and today we are going to discuss about options basics. So these are very fundamental things which I am going to talk about options. And of course, I think various folks who are part of this meeting, they are at different levels. So few of you are just starting with the options, and few of you have already done a lot of trading in options. But this session we'll keep it very basic so that everybody comes on to at least level one, and gradually we'll keep understanding the advanced fundamentals of options or advanced basics also. So let me share my screen. And the format of this session, how we will keep is I'll keep covering these basics one by one. And if you have any question, please feel free to ask. And and I will try to show you how to place those options orders on Robinhood as well as on Tastyworks. Maybe after we will cover this session, we will also try to do that. And then you can also ask question in the end. And I think Surbi, you shared couple of screenshots, so we'll look at that if we get enough time. Otherwise, I'll take those one on one. Anything else, guys, before we start?
We are good. Thanks, Varun.
All right. Okay. So as part of today's session, we will cover option basics. This is a very first class from for us. So let's begin. So before we jump into the options, we will have to understand what are the different asset classes where we can find avenues to make money. So first is cash. Everything should be aware of cash. So it is straightforward. Second is real estate. Even this is also straightforward for everyone, where people can make money by buying or selling. Commodities is another asset class where gold, silver, or even wheat, rice, these kind of commodities are traded in the marketplace and people make money. Fourth is bonds, where companies or government they issue bonds or treasuries. They are pretty much like a loan where companies or government they are giving an interest, and after a period of time they are supposed to pay back the principal also. The next is stocks. I think everybody knows about the stocks too. So we will not cover stocks today. We are going to cover options, which is nothing but derivative of it. Next is crypto. Bitcoin, Ethereum, lot of coins are coming up. It's a new asset class altogether and very interesting asset class. So I think I'm going to cover crypto also in one of our session if people are interested. The last is financial derivatives. And in this by financial derivatives, we are only going to cover options. So what are financial derivatives? Financial derivatives in a simpler terms is nothing but any system or any kind of logic if we can derive out of any other asset class what we have defined earlier. If we can bring a system around it, that is nothing but derivative. And we will see how options have been derived from stocks as part of this session. So let's cover option basics. So option basics, as part of options are nothing but a contract on 100 shares, which has got an expiry date and it has got a strike price. And I'll try to show you an example, couple of examples by which we'll try to understand how this contract works in the real world. But as part of this statement, just remember that every time we talk about one option contract, it has 100 shares. And just by knowing this particular fact, you can always understand what is the underlying value. So for example, if we are talking about Tesla contract or Tesla option contract, right? And Tesla is, let's say, trading around $800. So by virtue of knowing that option, there is one contract of option, you should definitely calculate that we are talking about 800 multiplied by $100 value. So it is become how much? $80,000. So that's the underlying value we are talking about, stock value we are talking about when we are trading in one contract of option of Tesla. So just like any other trade, there is a buyer and a seller of this contract. and that's how this marketplace is built, and we are able to trade it between two parties. So these options have a buyer and a seller, and in the options world, buyer buys an option and seller gives that option at a premium, and this is a premium which gets traded between these two parties for on options. And to understand in a very simple manner, options work just like an insurance. So think about it like just like when we go for a car insurance, we buy that car insurance from a insurance seller, for example, Geico or State Farm Insurance, and we pay a premium of that. So car could be of around, let's say, $50,000 or $100,000, but we pay a premium of just $500 every month. Similarly, in the options world, the underlying value could be way bigger, but the premium of that could be smaller. So if you understand insurance, options work just like insurance. In fact, in my opinion, insurance is nothing but the same thing which has been applied onto the cars or any other asset classes, what we are applying on the stocks. So insurance we are applying on other asset classes like say house insurance or car insurance, while options we are applying on the stocks. So there are two type of options. One is call, other is put. I hope if you would have learned about options separately, then you would have heard about call and put. So we'll look at those examples, how call and put works. But as part of this particular slide, remember there are 100 shares in a contract. They have got expiry date and a strike price, and there is a premium on which option are traded, and they work just like an insurance. Any question, guys? Okay, let's move. So let's look at call and put, and how do they work in the stock market or in the options marketplace. So when somebody is buying a call, he has an outlook, he has a bullish outlook in terms of he or she is expecting that that particular stock is going to go up in future. So you think the stock will be worth more later. So that is an outlook of somebody who is buying a call. So what he is doing, he is trying to lock in today's price to buy later at a profit. We can cover this one later if this statement is little complex. But overall, just imagine that Tesla is at $800 right now. Somebody is expecting it is going to go at $1,000. So if somebody is so bullish about it, they should buy a call. That is one way of using option. And we'll look at the example to understand this. So as I mentioned, like this works just like an insurance, right? So if somebody is buying a call contract or a call insurance, somebody has to sell that insurance to him, right? So similarly, when somebody is buying a call insurance, there has to be a seller who is going to sell that call insurance. So that's how, if once we will start looking at it in this way, it will be very natural for you guys to understand who are new to options. So there is a buyer of a call insurance, hence there has to come a seller of this call insurance so that this trade can happen. So there has to be a Geico insurance company to give me that insurance so that I can buy a car insurance. So now, given that a buyer of a call is bullish about a stock, a seller of a call has to become bearish about that call. How? For example, if I am buying a car insurance and I am expecting that I have given that risk of my ex car getting into an accident to Geico insurance company or to a State Farm insurance company. So Geico insurance company does not want that my car gets into an accident, and they are supposed to pay for that. Hence, they are always going to think in a different manner or an opposite manner the way we are thinking. We are not thinking about risk, but they have to think about that risk factor. So if a buyer of a call is bullish, the seller of a call or seller of the contract will have to become bearish. So in this particular scenario, a stock will be worth less later. That's what is in my mindset. That's why I'm selling a call to a buyer of a call. Is this example clear to you guys, or you have questions? Because I want that people who are starting with option, they understand these four things, and whenever they are putting a trade in the platform, they always understand what are they thinking of. Are they bullish about the stock? Are they bearish about the stock? So it should be very clear. So let's me move forward. Now buying a put. So a buyer of a put is thinking that stock is going to go down. So for example, if somebody is expecting, okay, Tesla has already inflated too much, Tesla will go down. By March, Tesla will become $500. If somebody is thinking in that way, he is bearish about Tesla, and then hence he could be a candidate who can think of buying a put. And similarly, because there is a buyer of a put contract, somebody has to become a seller to sell that put contract. So somebody sells that put contract, and hence if the buyer of a put is bearish, seller has to become bullish over here in this scenario.
Uh, Varun, I have a question.
Yes.
Yeah, see here, buying a call and selling a put, like both are bullish, right? Like we assume that like the stock may increase and is more worth in like couple of months.
Yes.
Okay, suppose say like I assume like Facebook might be going to hit like 300 by April or so. Okay.
Yes.
Like how is the different whether buying a call is more good or selling a put is more good? Like
Yeah.
I saw your trades, like you are selling put, like
Yes.
how is it safe, or like which one will be good? Like just I want to understand the difference.
Yeah, very good question. And I was expecting that somebody we should ask this question. Yes. So buying a call is also bullish outlook, and selling a put is also a bullish outlook, if you observe here.
Yes.
But there's a difference between them. We will cover that in the example, and we will try to understand how they're different with each other. But yes, when I am selling a put, I'm also having a bullish outlook of a stock. So most of the folks who start with option, they are generally in this particular area where somebody is buying a call. Mostly people are buying calls, right? And they have a bullish outlook. Sorry, they have a bullish outlook that all right, Tesla is going to go to $1,000 in next 1 month or next 1 week. So let me buy a call. And sometimes it goes, sometimes it does not go, and we make money or we do not make money. Or buy a put also. A lot of people also buy a put, and this is a bearish trade. But people sometimes mostly struggle with selling side of options. So we'll try to uncover that. Okay, so let's start with the call example. So as I mentioned, a buyer of a call is bullish on a particular stock. So similarly, we have tried to put a Tesla example over here, and a call buyer is bullish on Tesla and expecting stock to go above $900 by March 19th. Let's say buyer has got this particular outlook, and he is buying a Tesla call. So this is a trade a buyer of a call is going to place. So this is buy to open. So he's opening a contract. This is one contract. So this is plus one. Plus represents a call. March 19th, 78 days. When I place this ticker over here or example over here, there were 78 days. Um, and the strike is 900. So buyer is expecting it will go above 900. He or she is betting that. And C is for call. And when buyer of a call is placing this order, uh, he or she is supposed to pay. It is insurance premium to be paid because he is a buyer. They have to pay that insurance. All right. Always remember, whenever you are a buyer of an option, you have to pay a premium. Whenever you are a seller of an option, which is an insurance, you are collecting that premium. Just like the real world, seller of an insurance is going to get that insurance, buyer has to pay that insurance for your car insurance or for a home insurance. So in this example, a buyer of call is paying $36.55 per stock. And because we have got 100 shares in every option contract, and we have got one option contract here, it is 36.55 multiplied by 100, $30,655 as a debit transaction. So this is a debit transaction. Money is going to go out of their account, of the buyer's account, to the brokerage. All right. And as I mentioned, if there is a buyer of a contract, there has to be a seller who is trading with that person. So as soon as this particular contract for buyer has been opened, there has to be other party who is willing to sell that particular option. So in this example, sell to open -1. So minus represents selling, and March 19th, same date, same time period, 900 strike, same thing. Everything is same. The only thing is it's a seller of that contract. And if you observe, uh, premium is 36.60, hence multiply by 100, 3660. There's a little difference between them. It is because there is a bid and ask spread. We'll try to cover that either in this session or in the next session. But overall, there is a demand and there is a uh, ask of a particular contract, and there is a bid for a particular contract, which could have a bit of a difference. So think of it like in a marketplace. As a buyer, I want to pay less amount, but a seller wants to make more money out of that. So there will always be a difference between these two parties, and as soon as these two parties come together and decide a particular price, only then a trade will happen. Okay. So in this particular column, I have tried to cover the buyer side of it, and in this particular column, I have tried to cover seller side of it.
Varun, Varun,
Yes.
this is a call to sell, right? We are selling the call option.
I'm trying to show you complete example, buying as well as selling.
Buying a call left side and the right side one is selling the call.
Yes.
Okay.
Because once we look at them together, right, then you will see how this trade is going to happen. Ultimately,
Sure,
when we are buying a call, there has to be a seller of a call. And I am pretty sure most of you guys are hearing about GME, and lot of people like retail investors are a buyer of options, and there are hedge funds who have been seller of the options, and that's where the tussle is happening right now. Okay, so let's assume Tesla is at $650. I think it has gone up further now. When I put this example, it was around $650. So let Tesla is at $650, and call option contract has been traded between buyer and a seller for March 19th. Make sense, guys? This we have covered. So buyer buys a call with 900 strike for March 19th. He is very bullish about Tesla. So he has bought a call. Hence, seller has sold that call to the buyer, and there is a trade which is happening between these two. Now they are in a contract. Okay. So now premium of 36.55 per share has been decided, or has been shown here. So let's keep $36 as for the sake of simplicity. So buyer is paying that premium of $3,600, and seller is collecting that premium. Make sense? He's paying the insurance. He is collecting that insurance premium. So first scenario is if Tesla goes to $1,000, basically above $900 on March 19th, what is going to happen? So in this particular example, what will happen? Buyer is going to make $1,000, which is here, because now at this on March 19, stock is of $1,000. 900 minus 900. 900 is a strike price, which is here, minus $36 per share of premium. So $64 is the amount of money which a buyer is going to make per share. Hence, $6,400 is something which buyer is going to make in this particular example if Tesla goes to $1,000. Make sense, guys? And many people generally buy a call, and most of the time they understand this particular calculation, that stock will go above my strike price, I'm going to make money. And given that buyer is buying, making this amount of profit, there has to be the other party, because this is ultimately a marketplace. Somebody's gain is going to be other party's loss. So in this particular example, if buyer is making a profit of $6,400, seller is going to lose $6,400, and seller has to pay that amount of premium, pay amount of profit to the buyer. In the second scenario, let's say if Tesla remains below 900 on March 19th. We are just talking about March 19th, guys. Before March 19th also, every day option premium will keep changing, and till March 19th, these contracts will keep getting traded between the parties. So somebody will sell it to someone else, somebody will buy again. So, and every day option premium will keep changing depending on a lot of dynamics. We will not cover that on in this particular scenario session, but I just want to cover the basics of on March 19th what will happen, because that's the last day, that's the end game of this particular contract. So if Tesla remains below 900 on March 19th, what is going to happen? So buyer was betting that this Tesla stock will go above 900. I am pretty sure by March 19th it will happen. It is going to go up. But what happened? Tesla never went up. It is still below 900. It is still trading bit something around, wherever it is, but below 900. So in this particular case, buyer has lost his bet. So he is not going to gain anything. In fact, given that he or she has paid $3,600, so this is what will be the loss of the buyer on March 19th. And given that this bet never got executed, nothing happened, this bet has not been won by buyer, seller is going to keep that premium of $3,600. So this is an example of, for example, we buy a car insurance of 6 months, and if for 6 months nothing happens to our car, Geico is going to keep our insurance, right? He's not going to. There is no transaction which is happening. Everybody just goes home and we save. Only thing is we have paid premium every month, which is going to go to Geico. So it's the same case over here. Only when some particular bet has been executed, like bet is now we are bidding the bet here, then there is a transaction happening between these two parties. Make sense, guys?
Varun, have a question.
Yes.
So we have created a contract which expires on March 19th,
Yes.
right? Yes. With the price of 900. Say, suppose the Tesla goes to 900 a month before March 19th.
Mhm.
So what happens to my order?
Yeah.
Yeah.
So in that case
In that
also,
case also,
if
if
your option
your
price will
option
keep
price will
changing,
keep changing,
and if you
and
want
if
to
you want to
take
take
advantage of that
advantage
particular
of
day
that
itself
particular
before
day
March
itself
19th.
before March 19th.
Well, your
Well,
voice
your
is
voice is
echoing.
echoing.
Is it better now?
Yes, it's better now.
Okay. So good question, Pankaj. Before March 19th also, you can do the similar transaction. Only thing is, until March 19th, you have this particular option for you. So option, this is also called option because you have that option to exercise it. So you can close your contract early, and let's say Tesla goes to $1,000 on Feb 19th itself. Then also
Then also
you will be able
you
to
will be
close
able to
that particular contract.
particular contract. And so a related question. So suppose on a Feb 19th date, I think Tesla is around 850. And when we opened the call, it was around 650. And I decide to terminate my contract when it is at 850. What happens to my order?
Yes. So if you
Yes.
will try
So
to
if
close
you
your
will try
contract
to
early,
close your
right?
contract early, right?
What's happening every
What's
day?
happening
Your
every day?
options premium are increasing or decreasing depending on your stock price. So when you are closing your contract early, depending on that day's situation, you are going to make money or lose money. So for
So
example,
for example,
this is on, let's say on uh, 19th of January, the premium is $3,600. But on Feb 19th, your premium is going to be $7,000, right? So and
so and
it will happen
it will
because
happen.
your Tesla has gone to thousand let's say 850 very soon. So because of that, your premium will also get inflated. The way I would want to explain it in a very simplistic manner is, uh, the risk of your risk of buying this contract uh, has has decreased, right? So not it has actually increased. So the risk of so for the seller it has increased, hence the premium is also going to be charged more, and that is the reason this particular premium will also increase. So if I'll try to give you an example in a Excel sheet, let me show you. Maybe I'm not able to explain it properly. So for example, premium was 3,600 here, right? This is my contract expiry. Make sense? Now, if this is, and now, for example, here we have got it at $650. All right. What you are saying is on 19th of this has become $850. Correct? So what will happen in this case is, and you want to, let's say, take your profit early. You don't want to wait until 19th of March, and you are a buyer of a call where you have paid this $3,600. So in the real world, what is going to happen? This premium can become, let's say, let me say $7,000. I'm just putting in some example. This premium on 19th of February may become $7,000. And so if it has become $7,000, you can close this contract and you will make some money. So it will become, you are going to make a profit of $7,000, which is the current price, minus $36 profit for a buyer.
So this profit is on what you call this. What did you call this? This as a commission, or what? What was this amount? 3,600 and 7,000.
Yeah, these are premium.
Premium, right? So premium difference is giving a profit to a buyer if a buyer is closing the contract early, right? But so this is the amount of profit we will make, or this is the amount of means what happens to the option we have? Like it was a one option, right? Which is equivalent to 100 shares.
Yes.
So this is a total amount we are earning by closing the contract early.
You can. I mean, all I'm saying is, if let's say you are a call buyer and your stock is going up, right? You are going to make some profit even in the before the time of expiry.
Yeah.
But if it is become, let's say, 400 here, your stock has become $400, for example. Makes sense? Then this particular premium is going to be, let's say, maybe 1,500.
Yeah.
And then it is become a loss for a buyer, right?
So premium increases with the increase in stock price and it decreases with the decrease in stock price.
If you are buying a call.
Okay.
And mostly, not always, we will try to cover even the advanced topics. For example, in GME, I have been observing, because of volatility and other things, it's very tough to figure out whether am I making profit or making loss, because this particular stock price movement is just one parameter on which options run. There are many other parameters on which option pricing is dependent on. But for the sake of simplicity, for now, just think that all right, options are dependent on the stock prices, and depending on the stock price movement, even options premium are going to change. And
Okay.
this example we are looking at this one. Everything remains constant, only stock prices are moving.
Okay. And continuing ahead, say on 19th Feb, the commission is 7,000. So say if I continue to keep my contract open till March 19th, right? And the price continuously keeps going up as suggested, say to 950 or 900.
Yes.
So then so does the commission difference also applies here, or it's just like my
commission difference mean $36, right?
Yeah. So it will still stay 36.
It will always be there. This is the price a buyer is paying to buy this contract. Only when buyer pays this particular amount, only then a contract has been signed between these two parties. It's just like car insurance. Until we pay that $600 to the car insurance company, they don't send us the insurance.
Okay. So what exactly does this mean? Like, say if a order is completed on March 19th and Tesla's price is above 900, So does it mean like 100 Tesla shares will come to my account, or it is like just a commission which I'm earning?
You can do both.
Oh, okay.
You can do both. That is called exercising your contract, exercising your options contract. So as a buyer, you can actually exercise your options, and you can
Okay.
actually get those 100 stocks in your account
And at what price 100 stocks will come? Will it be 900 or 650?
at
Or
your strike price.
okay. So at the strike price, which is the 900.
Yes. So let's say Tesla is at $1,000, but you have a right to buy. So you can actually exercise your options, and you can buy those stocks at $900. But in options world, 99% of the people, they make premium, and they do this kind of transaction where they make a profit or loss on the premium itself, because your premium is also changing depending on your option pricing.
Okay. And means the way I understand then is like people usually close their orders before the expiry.
Absolutely. Yes.
Oh, okay.
Yes.
Because they are just playing around the premium, not actually exercising the options.
Absolutely.
Okay.
And very interesting thing which is happening. Many of you, if you are interested, I'm deviating from the topic. On GME right now, people are buying calls. By the way, if you would have heard of, Robinhood stopped uh, buying of GME stocks.
Mm-hmm.
People can buy only one stock at a time on
Yeah.
on Robinhood. So
Yeah.
what people are doing is they're buying call of GME on Robinhood, and then they are exercising it right away to get 100
Oh,
stocks.
okay.
Because they can do that. So
Oh,
instead
so
of,
you can exercise even before the expiry.
oh yeah, absolutely, anytime.
Okay.
But mostly it's not advantageous. People just do it during the end, or generally they don't even exercise.
Mm-hmm.
All right.
So since you are at the GME's example, say right now it's the price is way too high.
Mhm.
So say I am, instead of buying a call, I am selling it. Like I expect the price to come down. Say from 300, I expect it to come down to 100.
Yeah.
So this would be a sell call option, or
Yeah,
what
yeah.
would be
You
the
can, if you will sell the call, there are risks involved as well. Uh, if that particular contract or that particular trade will go against you, then you have to bear the losses, if you can see. So you have to be smart enough to understand what kind of risk you are undertaking.
okay.
So here you can also see an example of leverage, guys. So in derivative, it is very important that we understand the concept of leverage too. So the way leverage works is, uh, just by paying $3,600, imagine you are executing a contract on 100 Tesla stocks. So 100 Tesla stocks means 650 multiplied by 100, $65,000 value of trade you are able to run just by paying $3,600, right? So and I think I missed it, this particular part over here, the leverage. So in derivatives world, this is very important concept where you have got a lot of leverage with a small amount of money. It works in your favor when you do a right trade. It works against you, and you may make bigger losses when things do not work in your favor. So leverage works in both ways, but this is an advantage or a power of the derivatives world. So for example, in this particular example, we can a user or sell buyer is able to run a 100 stocks trade just by paying $3,600. Any other question, guys?
Yeah, can we exercise? C- do we need to if do we need to exercise this call option, or if we don't exercise, what will happen?
Yeah, you can close it. I will show you the example.
Okay. Also, if it goes to 1,000 in a second, maybe someday in the middle, for a second it goes up. Do I have a option to exercise whenever it goes up, or we have to manually do it?
You have to do it. Exercise is a button, or you have to call your broker to exercise your options.
Okay.
There's a two part. One is about managing the option contract also itself, like by closing it or by rolling it. There are multiple ways of doing it. Those options are generally present. But if you want to exercising your option means you are converting your option. Um, You are converting your option into stocks. That is exercise. So you are basically changing your asset class itself. So that is some more work. Hence, you have to do explicitly.
So Varun, what rate we have to buy exercise? Like I bought strike price 900, right?
Yes.
Suppose it went to 800 and my option becomes 0 on the last day. So can I exercise that option?
Yeah, you can exercise it anytime. What is the price you are saying? 1800?
No, $900 I bought call and it went to 800.
1800, 1800, right?
No, 800.
800. Okay.
So my call becomes 0.
Yes.
So then is it a good way to exercise or just leave that loss for 3,600?
You should leave it in that particular example because stock is still 800, right? So if
Right.
you will exercise it, it won't be beneficial for you. You are unnecessarily picking up the stock.
So
Because-
means I have to exercise at the 900 means I have to buy 90,000. I have to pay, right?
Yes.
Instead of that, I can buy at 800, right?
Yes.
Okay.
That's
That's
why
on my.
it is not advantageous if the stock price is actually lower. But many people might exercise it if it goes above that. Instead of taking a profit right away,
Okay.
they may plan to buy the shares.
Okay.
But it
And
happens
also,
very rarely.
yeah. Then second question is this call selling. So here seller keeps the premium 3,600, right?
Yes.
So what else if the stock price goes to like 800 on that day? The seller will get anything?
If Tesla remains below 900, seller is going to keep the premium.
That's it.
That's it.
So when the seller will get the profits?
Seller is breaking this profit, right? $3,600. This is their profit.
Profits. So we have to close the deal, right?
Yeah,
Have to close that.
Yeah, you can close it. But if seller does not close it also, Tesla remains below 900, seller will make this particular profit.
So the 3,600 I will get the 3,600.
If you are a seller.
Oh, okay. Got
And
it.
I will generally I do selling side, guys, and I have another video and as well as session for that. So we'll try to cover that. I'm thinking of covering that particular strategy next week itself, so that we are on a right track in terms of selling. I do 99% or 95% of the time I will do selling, and I work
Selling
just
the
like an
call.
insurance
Selling
company.
the call, right?
I don't do selling call too much. I do sell put. We'll cover that example.
Oh, okay.
Selling call is a bit more risky, by the way.
Oh, okay.
So,
Okay.
any other
Got
question,
it.
guys? Okay, so let's move. Let's move to the put example. In put example, a put buyer is bearish on Tesla, and he is expecting that stock will go below 300. I'm just putting an example that they are saying, okay, Tesla has inflated too much. Now it has to go down. So a buyer of a put who is bearish, he is going to buy to open one contract of Tesla for March 19th, and he's putting 300 as a strike price. He is expecting that Tesla will crash by March 19th and it will go below 300. Make sense? So, and he is paying a premium of $2.69 per contract, which is 2.69 multiplied by 100, $269. So if you see in this example, look at this. The premium is so low over here, $2.69, while the premium was so high over here. The reason behind that, while when I took this example, Tesla was at around $650, so $1,000 and $300. They were almost. I mean, the difference was almost nearby, right? I mean, similar. The difference is there are not too many parties who think that this is going to happen. So there are not too many people who are bearish about this particular stock, and hence the premium is also so low. Nobody is buying it. There is no demand for this particular contract. So this is just one way of looking at it. So hence, if somebody is bearish about it, So somebody, and he's buyer of a contract, there has to be a seller of that particular insurance contract. I call insurance again and again so that it comes in your mind very easily and you are able to understand.
So Varun, have a question.
Mhm.
So when you say, as we see, 2.69 is a premium here, which is
Yes.
very, very low,
Yes.
right? So say instead of giving 300 as a my strike price, I hope, means I think that, okay, from 650 it won't go to 300, but it will go to say around 500. So will that premium increase, means based on, and
Yeah, your difference is little lesser, right? From 650
yeah,
now. So there's more probability of stock reaching until that particular
yeah,
price. So your
right,
premium will be a bit more in that way.
okay,
See, just works just like an insurance. Like the insurance company will charge more premium if you are living in a risky zip code or a place, or your car is in a zip code which has got more thefts or more hailstorms or something like that. Your premiums are going to change according to zip code. So
yeah,
it is nothing but the premium, right? And similarly, this is a premium which represents how much risk you are taking. So if you see less premium, it means this particular price is seemed is people are looking at it with a very less risk. But if the premium is high somewhere, it generally means that somebody is that this premium is high because there are more risk involved. This is how you can look at it. Not always it is true, there are more factors, but 99% of the time, if there is a high premium, it means you must be undertaking more risk as well for a
so
seller as
what, yeah, so what happens if the price doesn't reach 300? So we lose $269?
well. But yep, we'll cover that.
Okay.
So buyer of a put, he is bearish and he has placed this call. Hence, there has to be a seller of this contract and he has placed a similar contract with 300 strike -1. Minus represents selling, and he is going to collect this premium. Tesla at 650 put option contract traded between buyer and seller. Buyer buys put with $300 strike for March 19. Seller has executed that contract for the buyer. Hence, there is a trade which is happening between buyer and seller. Premium of $2.69 per share. Let's, for the sake of simplicity, let's keep it as $3. Buyer buys a premium. So buyer is giving that premium of $300 to the seller. Make sense? Insurance company, buyer of a insurance, seller of an insurance. Scenario 1, if Tesla goes to $250 on March 19th. So Tesla has gone below $300 as buyer wanted. So buyer was expecting that Tesla will crash. Tesla has actually crashed in this scenario 1. So buyer is winning this bet. So buyer is going to make $300 minus $250 minus $3. $3 is nothing but the premium what we have collected. Hence $47 per share a buyer is making a profit. Hence it is 47 multiplied by 100 equals 4700. So if this is buyer's profit, seller is going to lose that amount, right? In scenario 2, if Tesla remains above $300 March 19th, again buyer has lost his bet. So buyer does not make anything. Only he actually loses this $300, which is an insurance premium. Just like car insurance, car never went with had an accident in 6 months, the whole insurance premium will go away. Hence here, seller keeps the premium of $300 just like an insurance company. Any question, guys?
So what else Tesla, if it goes to 600 on March 19th, what happened to the seller?
If it goes, yeah.
No, the buyer will become zero, right? If it goes to 600?
If Tesla stock remains above 300, 500, 600, 800, buyer is not going to make anything.
But the seller, he will get only 300 only.
Yes.
If it goes to 700 also, he will get only 300.
Yes.
Okay, got it.
Yeah. This contract has not executed in that way. So he's just collecting the premium. Make sense? So key takeaways as part of our very first session on options basics, Options work just like an insurance. This was the purpose of this particular session itself, that I wanted to just make you understand that you think from an insurance perspective whenever somebody is buying or selling an insurance options, that it is working just like an insurance, and things will become very clear to you that all right, this is a premium I am paying. If I'm a buyer of a premium of an option, I am actually buying this insurance, so somebody is going to sell that insurance to me. And just like in insurance, if there is a more the risk in a stock, there will be more options premium. So if you are observing right now, a lot of people must be observing GME, and the premiums are so high, right? If you are taking a call of, let's say, $200 GME, your call must be like $50 options premium. It is expensive because there is too much risk in that particular stock right now. Hence, the premiums are also very high. Just like car insurance, if your car or house is in a place which is very risky, uh, it's going to be the premiums are going to be higher. Options have got a lot of options. We are going to uncover those different strategies one by one, and also try to understand what works in our favor, what does not work in our favor. We'll cover them one by one. And meanwhile, every day we are going to share trades. Me, Vaishali, Jyoti, we are trading our trades, and feel free to share your trades also. In There is a Discord channel called Other Trade Ideas. You can share your ideas too, and maybe everybody will get benefit out of it. And if you have seen in this example, right, uh, buyer is also able to make money in some particular way, seller is also able to make money in some way. uh, you can you can also be bearish about a particular stock, you can be bullish about a stock, and you can be buyer and seller, and in those combinations people are making money. So in options, you can actually make money by being very directional, or you cannot be directional at all. We'll look at those strategies too. So that is the advantage of options in this. Uh, if you will see this example in these examples, guys. Any question, guys?
Varun, like you are going to like just I want to understand like that buy a call and sell a put, the difference, like when in which scenarios which will be more beneficial.
Yeah, we'll cover that. Let me show you. So what happens in here is, um, let me show you it from my example, guys. Just a minute, give me a minute. Yeah, let me show you. Okay. So I think, Ram, you were observing these trades, right? So these were the couple of trades which I did last week. So let me show you one of the example.
Mm-hmm.
So this is one of the trade which I shared, and Vaishali did a
Buy a call.
Vaishali did buy call
Yeah.
SNDL,
Yes.
correct?
Yes. Vaishali did buy call and you did sell put.
Exactly.
Just yeah.
So now let's look at these examples from the Tesla example what I've shown you. So what Vaishali did, she bought a call of Sundial at 0.5 strike for Feb 5th. Make sense? Let's see what is the SNDL. What is the price of it right now? Okay, so what Vaishali is expecting, that this stock is going to be higher than 0.82, sorry, 0.5 by 5 Feb 5th, and it is going to go up. So she is very bullish about this particular stock. All right. And if you see, this is actually going bit up. Even after hours, it has gone up. Friday, it has gone bit down. But overall, I think this is going up. From Tuesday, it was 0.50. Now on Thursday, it has gone really high. So overall, in her trade, I can easily see she is very, very bullish about this particular stock. And this is an example of this here. So she's a buyer of a call, and this is how her trade is going to happen. And if she closes her trade earlier, depending on the day, how if the stock is high or low, her trade is going to, or her options premium are going to be defined. But overall here right now, she has paid around 339, around $340 for this trade. So this is a debit transaction which has happened. Make sense, Ram? This is a debit transaction. She has bought a call.
Yes, yeah.
Okay, let me show you my example. What I did, and guys, I am hoping that you are able to see these channels. Let me know if you are unable to look find these channels, and we will try to fix it. Okay, in my example, I have executed put. Let me open this in another place. Okay, so
Is it under stocks discussion or options discussion, Varun?
this
You
is
made
in,
this. No, in the Discord.
no, this is these are the premium channels.
Okay, got it.
The member, you may not be able to see them.
Okay.
Okay, so in this particular example, I have sold a put. My strike is 0.5, and my while Vaishali was expecting it within few days, the stock is going to go up by Feb 5th, if I'm not wrong. I am betting until March 19th, and my I am just collecting 16 cents on each stock. So let's look at this particular example. Vaishali bought a call 0.5. Varun sold a put. Makes sense? 0.5. Both of them have a strike of 0.5. All right. Now buying a call and selling a put. Both of them have got, buying a call has got bullish outlook, and selling a put also has got a bullish outlook. Right? So it is, both of them are bullish. Now here, transaction is, I have made $16. So guys, this is a credit, by the way, CR, this is a credit transaction. So I have made plus 0.16. All right. And Vaishali has a debit transaction of 0.33 minus 0.33. This is clear, right? This is minus, this is plus.
Okay.
This is a debit transaction and this is a credit transaction.
Okay.
And that was a major.
So what is the difference? What is the difference? Like why means both of you are, means one is a buyer and one is a seller. That's why it's a credit and debit.
Yes. Buyer, as I mentioned, buyer of an option, buyer of an insurance is going to pay the premium. Seller of an insurance is going to collect that premium. In this particular example, Vaishali is buying the option insurance, hence she is paying that money. I am selling that insurance, hence I am collecting the money.
Okay, so if I understand correctly, when you are selling a put, you don't need to pay anything, but you will.
Absolutely.
Okay.
Whenever you are selling an option, you are collecting that money.
Okay.
That money is collected because you are selling that insurance. When you are an insurance company, you are taking somebody else's risk. You are taking a car risk, car accident risk. You are taking a home damage risk. So that's why seller of an insurance takes that premium.
And I believe that's why, as you said earlier, selling a put is much safer than other transactions.
It is safer if you do it right way. 95% of the time I do selling. and I have covered that in my other video. If you observe in my YouTube video, monthly passive income using options. This is one of the selling put is the strategy which I use, and this is my 90% or 95% of my strategy.
Okay.
And I don't do any gambling. Most of the time, whenever you are buying options, you are towards the gambling side of it. You make money. You make a lot of money in buying, but
Yeah.
given that nobody knows where the stock will move, people can only speculate. That is still a gambling from my side. But what we are trying to do is putting a strategy around it, putting a thought process and a framework, and then doing our trades. So you can watch this video where I'm trying to sell put and making money, and how is this helping us out. I'll try to have another session for this, but this is going to take more time if I'll cover it in this session. All right.
Varun, I have one question. So selling the put is, suppose if I sell a put $30,
Yeah.
so is that I am limited to only $30? If something happen, if I lose only $30, or I can lose more of that?
Or you can lose more. You are an insurance company. You can lose more. If things will go against you, you have to pay the insurance.
Okay.
Right? Just like somebody who is buying a car insurance, his car will go in an accident, he will claim that insurance from insurance company.
Got it.
Make sense?
Varun,
We are buying that risk.
yeah. Varun, now suppose say like
Ram, can you go on mute?
okay. Hello.
Yeah.
Yeah.
Can you go on mute? I think.
Okay. Just I have a question.
Yeah. All right. So if you observe, this is a difference. Both of us were on same strike, but I am selling a put and Vaishali was buying a call. So for her trade to go, if she has to make money here, she has to if stock goes 0.83 by Feb 5th, this is Feb 5th. So guys, in this particular example, what Vaishali is trying to bet here is that this stock is going to go really high. Of course, it is going to go definitely above 0.5, but because she has also paid a premium of 0.33, she has to make money on Feb 5th. Overall, her stock has to be more than 0.83. I hope this is clear because she has paid a premium on each stock. Now, in this particular example, why this is nice, this is a good trade also, and Vaishali said that, oh, okay, this is also a good trade. If you see her comments here, this one is better as gives more time on hands. I am bullish on SNDL. If I see it is going down, I might exit sooner. So why she is going to exit sooner? Because she's expecting that this stock will go very high very soon. So she will get a lot of premium and she will close this contract by making good profit. But let's say if she does not make any profit and she does not close on Feb 5th, if his stock is not going above 0.83, she might lose on this bet. But overall, right now, if I'm seeing this, this is already at 0.82. So hopefully on Monday it's going to go up and she might make more money. In my particular example, minus. So this is our break-even price, guys. Does that make sense?
Okay.
So what is that 0.34 means? 0.83 is for Vaishali, like if the stock goes above. If the stock comes below 0.34, then you make money.
No, both of us are bullish. We
Okay.
both of us want that stock should go high, but my break-even price is 0.34. If stock will remain above 0.34 on 19th of March, I am going to make money. But my money is small, by the way. My money is 0.16. For Vaishali, it could be higher.
Okay, it depends on how high the price of the stock
Exactly.
goes.
Yeah, because
But for you, it will remain at 0.16.
absolutely, because I'm an insurance premium seller.
Mm-hmm.
So I'm not going to make more money, but Vaishali can make
Yeah.
unlimited amount of money. But she is taking,
Okay.
but for her break-even price
Correct.
is 0.83. For me, it is 0.34. So that's where the big difference comes.
Mm-hmm.
So
Like it's like more risk and more profit and less risk and less profit. Okay.
exactly. Now you said the
Got you.
Yeah.
same
Yeah.
statement, right?
Yeah, got you.
So that was the difference between two of these trades.
So Varun, I have one question. So at a price of 0.34, can we close the deal like your thing?
Which one?
0.34, right? So that one.
Mm-hmm.
So when we close it, the strike price, the stock price, if it comes to 0.34,
No, I am bullish on this stock. Both of these trades are bullish.
okay,
These both of us want, we don't want stock to go down. Stock is at 0.82 right now. Price of a stock
uh-huh,
is 0.82 right now. Make sense?
yeah.
Uh,
So if it maintains 0.82, 0.82, we'll get the profits. If it goes down, we also lose, right?
yeah, if let's say in this case, if stock will go to 0.70,
Uh-huh,
right? Vaishali is going to lose on this one.
right.
But for me, I am safe until 0.34.
So as I was just looking at last 1 week's track for SNDL, it has been fluctuating a lot
Yes,
from point 0.5 to 0.8, right?
yes.
Right. So say it continues that trend over next 1 week.
Hmm.
So can Vaishali, means if Vaishali thinks that okay, this is going to go up and down. So as soon as it goes above 0.83, she will
Yeah,
execute or
yeah,
she will close, right?
yeah,
Instead of waiting for Feb 5th date.
yeah, yeah. That's
Because
what
on
she's
Feb
going to
5th,
do.
it might, yeah, okay.
Yeah, that is what must be her strategy. And that's the reason she has gone for a very short term, because she does not know what's going to happen for long term, right? And this stock will keep fluctuating. So she wants to make quick profit in this momentum, and she will try to come out of it. So that must be her strategy. That's why she has bought a call. My strategy is very different here. My strategy
Yeah.
is okay, stock, I don't see it is going to go below 0.34. So I am going to collect this 0.16. So somebody was asking how these in both of these bullish outlook, how are we different? So you can see the difference here.
Yeah. So in your case, right, Varun, you are collecting 0.16 by March 19th. Say if you think, okay, in any case, it is not going to go below zero point 0.5. So let me close my contract before March 19th. I close it on Feb 19th. So what happens? You still get 0.16 or you get less?
I may get less.
Okay.
I
So
may get less.
you have to wait till March 19th to get that 0.16.
If I want to get total 0.16, I will have to wait. But it is possible by Feb 19th, or maybe by tomorrow, I might make 50% of it and I'll close it.
Okay.
So I'll show you the
So you
example.
make 50%. You make 50% based on what price of SNDL here?
Yeah, yeah.
Say if you close it tomorrow.
Yeah. Let's say this is current price, right? Let's say SNDL will go become 1.1.2 on Monday. In both cases, both of us are going to make money. She has bought a call and I have sold a put. Both of us are bullish, and stock has shown the bullishness. Both of us are going to make quick money, but she is going to make money more because it is 1.2 minus 0.83. So she is going to make more money here. But I am going to make, because my 0.16 is the capped profit, I might make maybe 0.9 by that time.
Okay, because you are just exercising it or you're closing it before March 19th.
Yes. So my contract may have some money. So I'll show you the example here. Let's say if I show you my live example, how do I get rid of this? So this is my portfolio. And if you see my trades, right? Like this is for Novavax for Feb 19th, but already I have 90% in profit. And like this Neo example, because Neo already had a very good run, right?
Mm-hmm.
So Neo already is making me 71% profit. I can close it today and make $694 right now. I don't need to wait until
Okay.
March 19th, which is 47 days away, because already I placed a bullish trade, and now it's already shown its bullishness, so it's making me money faster.
Mm-hmm.
So all that happens in selling too.
These are all sell puts, Varun.
Yes, all of them are -1.
Okay, okay.
I do sell put most of the time. So like Apple, it has made me good money. Yeah, all most of them are sell put from my side.
So what is that -2 means?
Two option contract.
Two option contracts. You have done sell put for two.
Yeah.
See, like Pankaj, like sorry, sir, not Pankaj, like Varun, like see, like if when stock is falling or like going low, like the sell puts has like lesser risk, like right compared to the calls.
Um, it depends. I mean, if a stock is stable and you know, so if you know the price of a stock, it won't go below that, right? And
Mm-hmm.
you sell a put, it's a safe bet. So
Okay.
the way I teach, I suggest people is, you first of all you keep an investment mindset. Don't think a gambling mindset in terms of buying call or doing something crazy.
Okay.
You still think like you are a stock investor. You are
Mm-hmm.
buying stocks,
Mm-hmm.
but instead of buying stocks, you start selling put. And this is how
Okay.
I think about my trades. That if I want to buy Apple, like let's say this is Apple trade. Like these are the two trades I have placed on Apple. So I am thinking, okay, rather than buying 125 stock of Apple, I am selling a put for Apple.
Mm.
When
Okay.
you will start thinking in that mindset, you will never lose any trade.
Okay. Okay.
So in this case, right, I see two. One is for 125 strike price, one is for 110,
Yeah.
both for same date.
Yes.
So why so means why means do you feel like okay, there are chances that it might go below 125 but not to 110?
No, no, they are two separate trade. When
Oh,
Apple
okay.
was at around $115, I placed one trade. But then Apple,
Oh, okay.
I heard more news that Apple is coming with, I think they are making their own chips and other things. So and then Apple started going up. So I placed one more trade. They are two
Okay.
different contracts, but in both these contracts, I am actually bullish about Apple. Only thing is strikes are different,
Okay.
but there is no other change. But I think
So
110 I
commission.
put earlier. So if you see, this is already 63% up because I placed this trade a bit more earlier. That time Apple was around 117 or 118, and then Apple kept going up, up and up. So then I placed one more trade.
Like Varun, like I have a question here. See, suppose like say Apple got dropped down like say 4%, close to 4% on Friday. Okay, suppose say buy calls of like Feb 19th might dropped by 25% or 35%
Yep.
in that range. Like how like the sell puts might fall. Like
I'm
what is
not
the
worried until my contract does not go below 125. And actually, it
no
is
no
not.
no. Just I want to understand like what range of depreciation it will have like compared to calls sell put, like how the depreciation will be, what percentage kind of thing.
Percentage wise, yeah, I mean that's a very complex calculation, Ram. It is
Okay.
based on the this. If you know options are based on the some Black-Scholes equation.
Yeah, the theta, gamma, and all that
Yeah, yeah,
stuff.
yeah. So
Yeah.
it's a mix of all those parameters. I can't give you a number by myself.
Yeah.
But in brokerage they have calculated all these things by themselves. So these numbers keep changing every second. So they keep changing based on all of that. It's not just one parameter. There are stock prices there, in volatility is there. Um, then what else is there? Volatility and stock price. These are the major factors which keeps impacting these stock prices as well as time.
Uh, but like the depreciation will be like it will be little lesser than call, right? Like the fall in the sell put. Will it be like that?
Not really. Not in
Okay.
that way.
Okay.
Not in that way. Only thing is you have a cushion in the selling side of sell put, which I showed you in this example. This is a cushion for you, right? Like, because you have already collected this premium, you have got this cushion. In the Apple example, let's say if I talk about 125, right? I have sold a strike for 125 and I've collected here how much? $539. So 539, it is 5.39 per share. So basically my break even is not here. My break even is 119.61. I am not worried at all until my stock comes until 119.61.
Oh, okay. So 125 is just your strike price, but
Yep.
you don't lose till the time the stock price is 119. So say the way Apple stock went down, right, over the last 2 days, it is now around 131.
Yeah, I'm not worried about it.
Okay.
So and
So
you see even then, even after doing all that game, after crashing too much, I am still making 46% profit. On I think Wednesday I was making around 80% profit. I could have closed it on that day. I just thought, okay, it will go further up. Let me make 20% more, but it go.
Okay.
But I am still in profit.
Mm-hmm. Yeah. So if you would have closed your order on Wednesday, you would have gained 80% of.
Yeah. But now it went down, but still it is in green, and it will become 100% on Feb 19th. If it remains above 125, it will be 100%.
Okay. Above 119, not 125.
Above 125.
Oh, above 125, then only.
Yeah. Below 125, I will have to do more calculation because then it will become 123, let's say, and the stock price. But let's, for the sake of simplicity here, let's understand that once you will place your trade, it will become very natural to you also that you will be able to see, okay, why it is happening.
Varun, can I ask you a question? Mukesh here.
Yeah, Mukesh.
When you sell a put or buy a call, the amount of premium is deposited into your account right away?
Yes. When you
Okay.
sell an option, just like car insurance company, somebody has to pay the insurance money.
Okay. And one more question. Between the seller and the buyer, let's say one of them exercises the option
Yes.
and he wants the physical shares into his account.
Yeah.
How will get the share from the other person? He has to buy from the market and give it to him, or what?
Yeah, broker will manage it.
Okay.
Yeah. But yeah, you should, as a seller, you should always be ready for for the assignment.
Mhm.
If somebody can exercise and that randomly it is decided by the broker, so everybody should be ready for it. So that readiness comes with the mindset that whenever that you think, okay, you are anyway willing to buy that share, right? So if
Right.
somebody will assign it to you early, it's going to be beautiful for you. Why?
Right.
As soon as somebody gets this particular contract will be assigned to me before Feb 19th. It
Right.
is beautiful because I am making this 100% right away. Right now, I have to wait for Feb 19th to make this $539. If it
Right.
gets
Right.
assigned to me early, I will say thanks to the buyer that, okay, thank you for
Right.
exercising it because now this $539 are anyway coming. That contract is closed.
Coming sooner, in fact. Yes.
Yeah, that contract
Yeah.
is done from both sides.
Right.
I've got this $539. Now I got these 100 stocks. I will decide what to do for that. And
Right.
anyway, my strike is high, so next day I can easily sell this in the market for a better profit.
Right.
So exercising does not happen most of the time for the same reason because it does not work in the advantage of the option buyer most of the time. And generally people who do that, either they do it because they know something about the stock that say, let's say they know that stock is going to go very high afterwards if they are exercising their call. That is the reason they do it. So this is a way I do the trading. Most of my options are based on sell put, and this is what I wanted to teach you guys. And if you see most of my trades here, they are based on selling put. So if you are trading and you are following my trades, you should ensure number one, uh, that you are willing to buy that share at that particular strike price. Makes sense? And of course, your break even price is going to be little lesser, as I showed you in this example. But overall, you should see, okay, this is a strike price. I should be willing and comfortable to buy this stock at this strike price. Make sense? And 90% of the time we will not buy it, because we still keep ourselves away from the actual stock price. So stock will fluctuate a lot, but as part of my passive income strategy, as I have suggested you guys to watch that video, I have covered this particular concept explicitly. How do we do that? But overall, the idea is we remain away from the stock price and then we sell put.
So we do have access to that passive income strategy video, right? Means I'm not a premium subscriber, right?
Now, yeah, this YouTube video is available for everyone.
Okay.
And I'll try to cover this also in my next session or next afterwards. Maybe next session I'm thinking of how to buy shares for cheap. So we'll try to cover that. But guys, are you all able to understand why am I selling put, and what are these 4 different strategies and how can we use them?
I means session was definitely very helpful. Means I'm a novice user, right?
Yeah.
In the US market for options, and I'll probably get more insight when I try to do some trade. And
Absolutely. Of course, I mean, unless you practice it and do it by yourself, it will take more time. So you place 1 or 2 very safe trades. Let's say this sundial is a very simple trade, right? It's hardly $0.5. So even if you are going to lose, you are not going to lose more than $10 or $20 in a contract.
yeah.
Um,
So through Robinhood and through Tastyworks, right? It's more or less similar interface, or how does?
No, let me show you an example here. I think that's what we wanted to
Because
cover.
I just started, means a few months back I have a Robinhood account.
Yeah, I understand. No, I would suggest to get Tastyworks as well. It's you will see the advantages of that. I have also covered that, how to place options order on Robinhood, pros and cons of Robinhood to trade options. But let me show you one example of how to place that order here. Any other question, guys, before we move forward?
No, Varun.
Okay. I don't use this Robinhood. So
The dates we can select it randomly, or is it any specific dates we need to select?
I generally do monthly contracts. So monthly contracts of options expire on third of Friday.
Okay.
Third Friday of every month.
Okay.
Why I do that? Because that was a traditional way of options designing. I mean, the way brokers put options. Earlier they used to be monthly only, and which used to be expired on every third Friday. And now there are weekly options too and daily options too, but that was a traditional way. So hence there are a lot of traders who are still doing that monthly options, and I like it because I don't want to be in that day trading kind of mindset where I'm just always on to the screen and trying to place my orders according to the time of the stock movement.
Yeah, true.
So for me, as you have seen this example, right? I have placed this order on sundial. Where is that? This one. I don't care what happens to this particular sundial until it goes to 0.34, and whose probability is too low. If I see the sundial, so most of my trades are just set. Once I have set them up, I don't try to monitor them too much. If you see in last 6 months, after December, it has never gone below that. So it can go below that, but now given that now Biden has come and he's pushing this industry, so I'm hopeful that it won't go down. So yeah, this is how it is. Let me show you the example of Robinhood. So let me show you on sundial itself, since we are talking about it, and people might check that on Monday. So you can go here, sundial. This is a way most of the folks place their stock order, and below that there is a trade sundial options. So this is buying of a call. If somebody is very bullish, let's say the trade which Vaishali has placed, she has bought a call. So this is one way of doing it, and she's very bullish about it, and she is speculating about the stock. So for her, making sure that she exit this particular trade profitably, she has to monitor this trade. But what I have done here is I have gone here, sell and put. So now I'm selling put. I generally do 45 to 60 days of contracts. So March 19th is the right time for me. And I have placed this particular contract here. So short put, short is nothing but selling. Short put, 0.5 put, and it is giving 0.18. Now it is actually giving more premium. I have got 0.16. Right now it is showing me little bit more premium here. And let me increase the number of, where is the quantity I can increase here? I don't know. You guys can check. Okay, it's here. Let me just place one. So if I just place one contract, 0.15, I can make it. Good for day, minimum credit. So see, this is a credit here. So for each contract, I'm going to make $18. I think I have placed 20 contracts, but you.
So limit price here is your strike price.
No, limit price is the price for this contract, insurance premium.
Your
okay.
buying price. Like.
Yeah.
Strike price is 0.5.
Varun, I have a question. When you select the limit price for the option premium, I am very confused about bid versus ask, and I'm not sure what to choose and why.
Yeah. So see, bid and ask is nothing but there are buyers and seller in the marketplace, and they are bidding or asking for that price. So bid is the one which a buyer is saying, okay, I want to bid for this price. I won't give you more than $50. But a seller is saying, oh, I want to sell it at $60. Just giving an example.
Right.
So that bid and ask is nothing but the buyer and seller, they are debating against each other to come to a conclusion and to decide a trade price. So once you have a bid and ask, the price of it generally will be between that. So if you observe here, I don't think bid and ask it is showing here, but here this is a bid and ask actually for this.
Right. Yeah. 0.15 and 0.2.
Yeah. So what buyer is saying is, oh, I want this contract for $0.15 per share. And seller is saying, no, I want to get $0.20 for this, right? Because buyer wants to pay less premium. Just like in car insurance, we want to pay less premium, right? But a Geico would want to make more premium. So there's the same battle happening over here. So you can easily expect that you will have to pay either between that, or either you have to come at 0.5 or 0.20. So I just put 0.18 as a middle price. But if you want to buy it very quickly, if you want to sell this particular contract, since I'm a seller here, right? So I will have to make 0.15. Now I think I've already placed this contract, but if you have to quickly do it as a seller, then you will have to reduce your premium price. But if you're a buyer, then you will have to increase your premium price because you want to buy that contract. But ultimately, it's nothing but between buyer and seller, there is a fight happening, and one will win, one will lose in that negotiation. So if you see this one contract, minimum credit, I will receive $18. In Robinhood, I will have to put a collateral of $50. $50 came from here because the strike is 0.5 multiplied by 100. So that's the amount of money Robinhood would want from me. So I don't trade on Robinhood, so it won't allow me since I don't have buying power.
Varun, like Tastyworks doesn't no need to have collateral, like it will not hold any collateral.
So Tastyworks, it's a margin account. So margin works little differently. In margin account, also they have this buying power concept. But in Tastyworks, the biggest advantage is that it will not take too much amount of money. So if like it is taking $50 here as a collateral, in Tastyworks it will take less. So I'll show you the example. So this is an option chain here. Here it is like this. On Tastyworks, it is a bit more complicated, but don't get into all this. We will try to uncover these other things one by one, but for now this is an option chain. In the left hand side this is call, and in the right hand side this is put. It is put here written and call is written here, right? And let's say I have to go to March 19th. So March 19th is here, and I will have to place for 0.5. I'll click here. So now right now it is buy. I have to convert it to sell. I've got 20 contracts, so let me reduce the number of contracts. Okay. So now sell to open, S is for sell, open, -1 contract, March 19th, 0.5 put. So I'm selling -1 put. Okay, so same here, bid and ask, like buyer and seller, they are negotiating against each other, that who is going to win. So I am placing a contract for 0.18, which is middle of it, but if it does not get filled, I will have to change it to bit more up or down. Okay, sell to open, all this, I am getting a credit of $18. My buying power is reduced by how much? 33.15. And that's why I keep telling people that there is an advantage of using Tastyworks or some other account, because your buying power do not reduce just like Robinhood. So in Robinhood, my collateral is $50, but here my buying power is reducing by $33. And
Okay, so it means it wants you to have $33 to place this trade. Say if you don't have any, right now you might have some money in your account, and from it is.
yes.
Okay.
But here it is reducing $33. In Robinhood, you will have to have $50. So
Varun, like I like when we have like with little buying power, like we cannot buy like Apple, we cannot sell Apple puts or like AMD puts, right? Like they need more
yes.
right
So
collaterals.
yes. So let's say if you are on Apple, so let's see how much Apple is charging me. If I try to sell Apple on March 19th, let's assume $100, huh? Just for the sake of calculation. No, what am I doing? No, it's not coming properly. Let me show you some other example.
AMD?
Maybe T. T is for $28. Let me put $20 or $30, $25. Okay, this is working. So if you see T, this is a T-Mobile. Sorry, this is AT&T. It's taking 223 buying power reduction, while what I am placing the underlying value is 25 multiplied by 100. So T stock strike is 25. So underlying value is 25 multiplied by 100. So 2500 is the underlying value, but it's just asking me $223, which is nothing but around 10% of it.
But whereas Robinhood will ask collateral to 2,500, right?
Yeah. Robinhood will say, okay, let's see this one. Sell. And I'm just showing you because there's that's it. This is the advantage of having these brokers. You don't want to do sell put on Robinhood. So this one, sell short put 25. Okay. One contract. Let me put some, let's say this is a credit. Okay, collateral of $2,500, guys. So now you see the advantage of using these brokers, the other brokers. So on Robinhood, you will have to have $2,500 to place this trade. But on Tastyworks, you just need $223. Mind you guys, I still have portfolio margin, but for you also it will be very less. If you are just starting on another simple account on Tastyworks, the normal margin account, it will be less. Having said that, does not mean that you will have to go, full on to using margin and just crush yourself. Please do not do that. What I suggest in my strategy is that you should always have 30 to 40% as cash in your account, because you will face those situations where you have to take assignment, and for assignment you have to take more money. So for that you need more cash, but if you are smart enough, you can always make money, and 90% of the time you are going to win with this particular strategy. All right. Anything else, guys?
No worry.
So there were a few more examples. Let me see if there were any other problem. So we place all these trades as sell put. This was a beautiful trade. I shared a few more insights on this. So credit per contract, buying power reduction is just $151. So I placed this particular contract, and I shared the ROI percent and annualized ROI. So sorry, this is a different trade. This is a vertical trade, but this is also sell put vertical trade. I'll also try to cover this in another example. Let's not pick this one up. Sorry. This was a beautiful trade, PCPL. It is a SPAC of $10 floor price. This trade makes a break even itself at $8.6. So let's look at this one. This was a beautiful trade. I loved this trade. I placed this on, I think, Thursday. So you know SPAC, right? Most of you guys?
Yes, Varun.
So SPAC, the floor price itself is $10. All these companies who are launching their SPAC, there's special purpose acquisition company, which has got no business, but they are going to acquire some physical company. That's a business model of a SPAC. All these SPACs are getting launched at $10 floor price. So guess what? I sold a put for $10 strike price for March 19th for PCPL, which has got 2 or 3 days back only it has been added for options. It was not there for option trading earlier. And I found a beautiful deal in there where they are saying giving a premium of 1.40, which basically mean I have got a strike of 10. This is a SPAC which has already got a floor price of 10, so it won't go below 10. Transaction, I am making how much? 1.40. 1.40. What is my break-even price? 10 minus $8.6. So it's a no-brainer. I mean, it will not go below 10. I can actually put way more many contracts for this, and by March 19th, all of them should win. And even if it goes below because of some reason, let's say this SPAC was bad or the company which they acquired it is bad, which I have not seen in any SPAC that it is going before acquiring a company they are going below 10. But even if it will go, this is like a 14% crash. So it has to go 14% down just to come to this particular value.
Varun, like suppose say like tomorrow it went to $11.
Yeah.
Okay, you want to like in order to like close this transaction, what you will do? You have to buy, like say, buy a call, sell a call, right? Like when we buy, we have to get out of the call, we sell the call.
Yes.
Now how do you get out of the sell put? Like,
so let's say if I want to close this Apple, right?
Mm-hmm.
This is a call. So if I click on this, in Tastyworks I'm showing, since I do not have any open contract in Robinhood, but in app, if I go here, I'll click here, there's a close position.
Mm-hmm.
I'll click here. So you can see this has placed a trade for me automatically when I'm putting a close order. It is saying sell to, this is not working today very well. Yeah, now it is come. So now it is showing me buy to close. So I had a sell to open. So now I have to place an exact opposite order, which is
Okay.
buy to close.
Okay.
So now I am buying it. So to close any contract, you have to place exactly opposite order. If you have sold it, you have to buy it for closing. If you have bought it while opening, you have to sell it while closing.
Okay.
So now I'm buying to close, but good thing is it shows me close also CL here. So it tells me, okay, I'm closing this. This is a closing order. And when I'm buying it, so it shows me OP as open order. So this is an open order, but this is a closing order. So if I close this, if buy to close Feb 19th, it is showing me profit automatically. And this is going to take some money. So given that I am now placing that order before Feb 19th, right? Feb 19th is still 19 days away or 20 days away. So it's going to give have some transaction cost to have this contract running, executed. But I'm going to make $100 now.
Okay.
I think Pankaj was asking me this question, right? How do we open and close, and what's going to happen if I'm going to close this earlier when we were discussing about this Tesla order, right?
Yeah.
So this
Yeah.
$850, right? This is exactly same example. So when I placed this order, um, I think Apple was around 115 or $117, and now Apple is $131. Now I can wait until Feb 19th to make full money, $158 money over here, or I can close it today itself and I can make $100 right away.
Okay.
So yeah, this is what I wanted to show you. I have covered Robinhood and Tastyworks. Okay. Any other question, guys?
Just one last question.
Yes.
If you like in stocks, we order at particular price point, you can buy stocks, but here we don't have that option, right? Like at complete this execute this contract call option at this price. When even if it goes like maybe an hour, it stays above 1,000 for Tesla, and it goes back again to 500.
Yeah. No,
We have to
you can close that contract, right? When it is going to $1,000, at that time you can close that contract. See, just like in stocks, let's say you have bought a Tesla stock at $500 and Tesla went to $1,000.
yeah.
So you will sell that stock, right, at that particular time. So you have to time your trade.
Yeah,
Similarly,
but
you can do here
we have
also.
to manually do it. But there we have option of like selling by itself.
Oh yeah, you can do that. I
We
don't know
can
about
do.
Robinhood, if you can do that on Robinhood, but here I can do it.
Okay. Okay.
Like if I can do it close profit percent, and I will set it up. Let's say I will say, okay, by 80%, start closing order.
Okay.
I can do that.
Okay.
So I will place this order and it will place, I'll just put this order here and it will place my order automatically. And as soon as it will reach to 80%, it will automatically execute my order.
Oh, great. Okay.
All right. Anything else? So I just main why I covered these examples are so that I am sharing these examples, these trades of mine over here. So you should be able to at least understand them. You don't need to follow all of these trades and execute these trades. But whenever I'm sharing, you can see them. You can try to understand. Okay, what am I trying to do? This sell put, what is a strike? Is it safe for you? Is it not safe for you? Is it taking too much amount of money? So all those things you should be able to understand from these trades, and we'll keep uncovering our trades one by one, understand more strategies one by one, and I'll place few trades just to understand a strategy so that it becomes more clear. But yes, one thing which is clear is um, selling option is more capital intensive. But if you are a stock trader traditionally, it is going to be beneficial, and you will have you can think you're still in the minds as a with the mindset of stock trader, but you can sell put and make more money.
Varun, you have few minutes to go over I sent you some trades I did last week.
Yes.
Those are
Yes.
my very first option trades after listening to your videos and comments and all those
Okay.
things. Okay, is
Okay.
there you have few minutes to comment on that? Or?
Yeah, sure. Guys, anything else?
Varun, I want to say something. This is Preeti.
Yes. Hey, Preeti.
Yeah, hi. So Varun, your session was fantastic, and I am like someone who was hearing those words "sell and put" for the first time in my life, and you explained it in a really good way. Thank you for that.
Thank you.
And right now, I don't have any question, but I'll do some of my homework, and definitely, I'm going to ask more questions next
Yeah,
time.
yeah,
Thank
sure.
you.
Yeah, sure, Preeti. Thanks a lot. It means a lot. Yeah, it's a very new community, but I want to help people. And I have also learned by losing too much money in these in trading. And I have what I figured out it there are a lot of things to way we can make money and lose money. This is a strategy which I found that I can follow all over whole of my life and I can make some money. And that's why I wanted to share with you. But of
That
course,
is true.
there are more strategies people may know about it. Feel free to share and we can discuss about it. And there are more experts, who have found their own way of doing trading and make money. But yeah, at least this is what I want to share and we want to follow. And I hope everybody will be able to appreciate this particular strategy.
Yeah, this is fantastic.
Yeah,
Thank you
thank
so
you.
much.
Thank you.
Yeah. Thanks, Varun. Thank you so much. Like I got like clear picture now, like of the
Okay.
selling put, and like actually I was like just buying the calls and
Yeah, yeah.
just buying the puts.
Yes.
But like now, like I understood like the much understanding on like how the sell put is more like safer compared to the buy calls.
Yes, yes.
And like also, yeah,
Yeah, this is true.
really I liked the session, and also like I will be following your trades, and like yeah,
Okay.
thank you so much.
Yeah, thank you, Ram. Yeah, and feel free to ask question when I'm placing those trades. You might have more questions. Always ask questions within that channel itself, and we'll try to answer that. Or if it will take more time, I'll try to cover them in the weekend session, and everybody will learn from them.
Varun, can we get these recorded video, right?
Yeah, this is a recorded video. I'll share with you.
Okay, thank you.
Yeah.
And like Varun, like general question, like see while picking your trades, like how do you do that analysis and all that stuff? Like you use that RSD, RSI, MACD, and all that things, and like you
Yeah, yeah.
pick the trades, or like
So earlier I used to do more.
yeah,
Nowadays I don't do too much because I see a trade and then I just try to sell a put which is away from the market.
okay,
So that is my strategy. Earlier, when I was a stock trader, I used to do that RSI, MACD analysis, everything.
mm-hmm,
But after being doing this from some time,
mm-hmm,
I just see a trade and I see in a chart, okay, what is my good price where my stock will never go, and I plan to sell a put. Only thing is, whenever, and again, this is my strategy. You can have your own strategy, and once you learn it and master it, you will play your own game. But my strategy is I will always play with the stock which I am willing to own.
okay,
So GME is something I don't want to own, so I'm not playing a trade with that. But I
okay.
know people are trying to make some speculative money from that. Uh, but I don't want to own GME, so I'm not placing a trade on them.
Varun, I have a question. It's
Mhm.
Surabhi.
Yes, sir.
Thank you for the session. It was very informative.
Okay, thank you.
Mm, you just said that you usually sell puts,
Yes,
and do you do in the money or out of the money?
out of the money. I
Out
do
of the
I
money.
do in the money too. If I have to buy that trade, I have to buy that stock. I do in the money too.
So in the money, like
So I didn't want
you
to
you.
cover in the money, out of the money. Maybe I'll cover that in the my next
Okay,
session.
okay,
But guys, for the sake of everyone's understanding, in the money means um, stock is very close or at the stock price itself, or the strike is very close to the stock price. That is in the money. Out of the money is the strike price is very far from the actual stock price. But mostly Surubi, yeah, I do out of the money. But if I am very bullish or if I want to own the stock, I do in the money.
okay.
Yeah, and we'll try to cover that maybe in next session or next to next session. as I will be able to find out what is the right time to bring that one up. But mainly what I wanted to bring everybody on the same level is that they are able to appreciate these trades, and if they want to place it, they at least they can start placing it. And one by one we'll try to uncover these various topics. So if there is no other question, then I'll take the Surbhi's question and trades what Surbhi has shared with me. So guys, yeah, I think the session is over. And I'll cover Surbhi's question. If you want to be here, it's fine. Otherwise, you can leave the call too.
Thank you, Varun.
Thank you. So Surbhi, you have shared. Okay. So, all right. So you have placed these orders, right?
Yeah.
And when you say covered call, you have these stocks, isn't it?
Right.
Okay. So I think we are good with these. All these are covered calls, and this naked put. Number of options, strike price is 8. Yeah, bingo is at around 10 or 11 right now, so even this one should be good. And you are willing to buy at 8 if it comes down, right?
Right. Yeah.
Yeah, this is beautiful. This is what I follow, and this is what I want to teach to everyone. Covered call and naked put, they are money makers.
Okay.
Okay, like Varun, like here, like naked one is like the one you don't have any shares and trying to sell a put, right?
Yes.
And, okay,
Yes.
okay.
All these are naked puts.
Okay.
What I showed you in this example, these are naked puts.
Yeah, these are naked puts. Okay, naked means okay. That means you
Yeah,
don't have
naked
any shares.
put means, guys, for everyone's understanding, naked put means is nothing but there is no underlying, there is no stock we have. We are just selling that put with the money what we have got or the buying power we have got. So most of my trades right now, they are naked put.
Okay.
And covered call, we will try to cover in other examples. But I see you have placed, Surbhi and Mukesh, I think you have already placed these orders. So this is good. But for others who are new to it, I'll try to cover them in one of the session.
And like say now, say bingo now currently it's trading some 10 point, right? And like it's good to sell a put with lower price or like what is like thing with lower price it's good or like with a higher price
No,
like
yeah,
about 10?
sell put, try to keep it on a lower price.
Okay, lower price. Okay,
Yeah.
getting at 8 is good like compared to getting it
Yes.
higher. Okay.
I think all these trades are good, Surbhi and Mukesh. So
yeah, thanks, Arun.
So this is good. And let me see this one. So I think, so this one, uh, I am not the one who is an expert in running these kind of trades. This is a double diagonal trade, but I can tell you what is happening in summary in this trade. But this trade is a speculative trade. If you are entering in this trade, you will have to monitor this trade full time. Because GME is going up and down. You never know when this will go down or up, and you will have to entry and exit. You have to plan your entry and exit quickly as soon as these stock movements happen. Plus, if trade does not go well, then you will have to place more trades. One more thing is, for this stock, if assignment happens to you, which could happen, um, your liability of assignment is how much? Your selling of call is 300 and 400 put. Okay, so your liability is around $40,000. And I do not know if you are running on margins too. Maybe on margin it will not charge you too much. Actually, on margin also it will take you your $40,000. So what can happen in the worst case situation? Worst case, of course, maybe it is just 0.5%. Of course, stock can go up and down, and it can play its own game. You might be profitable or you can lose. So that is also anyway possible due to volatility and stock movement. Another aspect what can happen here is you may get an assignment on one of these, on your 300 call, sell call, or on your sell put. You may get the assignment before 19th of Feb. And if you get the assignment, you will have to be ready for buying these stocks. And that is what I'm suggesting, that you should, if you are doing this trade, you should also be ready for that aspect. So in the summary, what's happening in on 16th of April, you are making one straddle, and these are two bullish trades. Sorry, this call is a bullish trade for 16th of April. So you are expecting it will go above 200, which is already there. So you are going to make money through this. And here this is a bearish trade, and below 500 you are going to make money. So this is good. If you are placing these two trades, this is good. Why these two trades have been placed is just to make this particular trade little cheaper. That is the reason of having these two trades here.
Okay.
Okay. Otherwise, if you are just buying these two things, 16th of April, you are paying 210 plus 361, around $550 per stock, which is around 55,000. But by selling these two options here, you are actually making it cheaper. So that is the whole intention of it. So because of having these two contracts here, your overall contract value becomes around $20,000, around 191,000. Yeah. But overall, um, I don't know. You can have lot of things happening here. It can, if it will go it will crash. You might lose money because of volatility problem. So there are too many ifs and buts here. And honestly, if you have a portfolio of around 100,000 or 200,000, then you can place this trade so that you can manage all your risk. But if you have a smaller portfolio, please do not do this.
No, we are not doing it. We're just trying to understand it. Basically, we're not doing it. No, no
Okay.
way.
Yeah, don't do
No, we
it.
are not doing it. No.
Yeah, okay. Yeah, you can make money here. I can see how you can make money here, but if it will go wrong, then there's too much risk here.
Yeah. Thanks, Varun. Thank you so much. It was so informative.
Yeah, thank you, buddy.
Yeah, thanks.
All right, guys.
Yeah,
Okay,
thank you.
so yeah, thank you, everyone. Yeah, we'll keep having these sessions. I'll try to see what is the good other sessions we can have, and feel free to ask questions in the channels. Yeah.
So will
Thank
you
everyone.
share your trades, Varun, on the premium channel or?
Yes, in premium
Okay.
channel.
Yeah, thank you.
So this is the one. Uh, so before we leave, I think who was the one who did not? Somebody was there who was not able to connect, right? I was talking to him. Let me stop sharing. Anand, right?
Hey Varun, it's me, Anand.
Yeah, Anand. Yeah, let's after closing this call, let's come back on Zoom again, huh?
Yeah, sure.
Okay.
I'll be staying on the Zoom as is.
Okay.
Yeah.
Thanks for the session.
Yeah.
Look, it's
Thank you,
really
everyone.
helpful actually.
Thank you, everyone.
Yeah, thanks, Varun.
Thank you. Okay.